Let's get to today's market movers with easy to follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Iuorio, and we're a couple days away from a very interesting payrolls number. Now, if you remember last month, we saw a negative 33,000 print that was hurricane related, and the markets seemed to be okay with that. Now, this month, we're expecting a huge rebound. Curious as what's going to happen if we don't get it. We're looking at using S&P Futures E-minis to position for this event. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay. A huge week for info. We have Russia, we have a Fed chair, we have Apple earnings, and finally, the biggest thing on Friday, the jobs number. Is the jobs number the biggest deal of the four?
The granddaddy being the jobs number. You know what's funny, Jim? Is probably on Friday it's the biggest thing going right now, but gosh, we've seen all the rumors about Russia, as you mentioned. The Fed chair talk is heating up, certainly, and then the earnings stuff before then. So I would say it leads up to the big granddaddy that is the jobs number, but until then, it could be a lot of market forces at work.
We're expecting a 312 number. Now, every month for forever, it's always around 180, the expectations. So the 312 is incorporating the negative 33 from last time. If we get a 200 number, how quickly are we going to take out Fed expectations, or are we at all?
Well, I think that will definitely impact Fed expectations because that would be a surprise to the downside. That would suggest that maybe this economic heating that we had over the summer is starting to cool off with the weather outside, if you've seen it lately here in Chicago. But the reality is this, it still is one number, and you take that coincident with all the other economic data that's out there, I still think the Fed can go through with a rate hike in December.
I agree that it's one number, but it's one big number. Now, before we dive into our trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional opportunities, not as recommendations or advice. Prices of movements will vary. When we're pricing these out, the DES ES, the E-mini contracts trade about 25.70. Scott.
25.70.
How about that?
Yes, I mean, it's
just keeps
unbelievable.
going.
Just this stair step all the way up, isn't it? And that's why, Jim, I'm punching up a lot of call spreads and put spreads today as we look at expressing ourselves here in the show. And I'll tell you what, I found something that I think is interesting from the standpoint of I feel pretty confident in. Let's say it doesn't have the greatest risk reward, but it's the following. I'm looking at selling the NoV1 25.55, 25.40 put spread for 2.1 ticks. So not taking in a ton. It expires November 3rd, so only a few days until expiration. Underlying, as you mentioned, at 25.70. It's going to risk 640 if it fills out to make the potential 110 that you can receive in net premium. Because, my friend, when I look at taking in premium, I want a short expiration. I don't want to hold on to that very long. I think this is a good setup. There's also a 20-day moving average around on the ES at 25.55.
Yes.
I have not seen that broken yet. I think it's going to hold.
You look at this and say you're collecting only 2 ticks and could potentially lose 13, and you'd say, wow, the risk reward doesn't look good. I make trades like this every week, and they usually have been pretty good. Volatility has been staying low. Realized volatility is even lower than implied volatility, so I do not think this is a bad trade despite that. Mine's a little bit different. It's the November 3rd, also the week 1, 25.85, 25.90 call spread for 1 tick. Goes off November 3rd, just like yours. Underlying's 25.70. It risks just the $50, the 1 tick you put up. And I know this is a pretty narrow spread, and it's 15 ticks to the upside, but key, it's 15 ticks to the upside, and that seems to be the direction we're going. Thoughts?
Love the risk reward. And the only question I would ask you is, why cap it in that case? I mean, it is a very, very small window to take in the sense that maybe I wouldn't sell that longer call spread just because I'd say I'd just own the short call, the near call spread, or the near call rather, just because I think if the market's going to go up, I don't want to be capped at, say, 5 ticks.
I still like my trade, but that makes a lot of sense. You know what I mean? It probably would be fine just to buy that the 85 call and let it go. You know what I actually probably would really like is to sell your put spread and buy our call spread, because it's just 2 different ways to express a slightly bullish viewpoint, eh?
You can take one of each of the sides and just do it that way.
Right. Okay. Give me the Fed chair. Who's it going to be?
Gosh, I still think it's going to be Yellen. I'm holding out hope that Janet pulls away from the pack. I'm just telling you, I think stability is going to be key at the Fed.
I say Powell, and that's going to be viewed as somewhat stable. Thanks for joining us on Market Movers. I'm Jim Iuorio, where we're helping to make you a better trader.